Hello, and welcome to this brief presentation on the U.S. gift and estate tax planning for foreign investors. I'm Jacob Stein. I practice in Aliant's Los Angeles office, and I do a lot of work in this practice area. So, foreigners are subject to a separate set of rules when it comes to transferring assets, separate from the rules that apply to U.S. persons. How the United States imposes a gift tax or an estate tax on a foreigner who has assets in the United States. That's the subject of our conversation, and primarily, how do we plan around the application of these rules? So if you live outside of the United States, if you are what's called a non-resident alien for U.S. tax purposes, you may have assets here, right? You may have invested money in the U.S. bank account, you may have bought U.S. real estate, invested in the U.S. business. What happens if you transfer the ownership of those assets during your life? What happens when you die and then those assets are transferred to your family members? So the United States imposes either a gift tax or an estate tax on the transfer of assets. The gift tax is imposed on assets transferred during your life. The estate tax is imposed on the value of assets transferred on your death. Both taxes are really one and the same tax. It's just one is designed to apply during life, one on death. It's a 40% rate of tax that is applied to the fair market value of the assets being transferred. So let's say that our client who lives in China bought a property in Southern California. The property is worth $2 million. It's a house, and now their kids are moving to the United States. And now our Chinese clients wants to transfer the ownership of that $2 million home to their children who are moving to the United States. It's a transfer from a parent to a child. Does a tax apply? The answer is yes, absolutely. A tax does apply. And the tax on the transfer of this home will be $800,000 US dollars, 40% of the value of the asset transferred. How does the United States get to tax somebody who lives outside the United States? And someone who lives, let's say, in China. Well, because they have property, they have assets in the United States. That gives the United States jurisdiction to tax. So transferring real estate, transferring a business, transferring intellectual property, all sorts of assets to children, to family members, to friends, will be subject to 40% gift tax from the first dollar of value. There is no exemption. But there is a very interesting planning opportunity here. This is how we usually accomplish gifting assets to family members for our foreign clients. The one big exemption that exists is that the United States will not tax a foreigner on the gift of what's called an intangible asset. Right, so a tangible asset is something that you can touch and feel, like this jacket, right? That's tangible. An intangible asset is sort of an abstract concept. One of the intangible assets that help us with this planning scenario is an interest in a legal entity. An interest in a legal entity, like an interest in a corporation or a limited liability company or a partnership, these are all intangible assets. And if our foreign client gifts an interest in one of these entities to a family member, there is no gift tax. So an interesting planning transaction presents itself. Our foreign client in China can take their $2 million property that they own in Southern California, transfer the ownership of the property, let's say, to a limited liability company. There is no tax on that kind of a transfer. And then they take their interest in this limited liability company and they gift that to their children. Now they're not gifting real property. Now they're gifting an interest in a limited liability company. That is an intangible asset. The gift tax does not apply. That's an easy way for foreigners to move assets into the hands of their family members without the application of the 40% gift tax. The estate tax is a little bit different. The estate tax will apply to any assets that a foreigner has in the United States at the time of their death. There's an exemption of $60,000, meaning a foreigner is allowed to have up to $60,000 in the United States, and that will not be subject to the estate tax. Every dollar above the $60,000 is subject to the 40% estate tax. Okay? So the primary planning for foreigners who will have assets in the United States is to make sure that they do not have assets in the United States, meaning that they do not directly own assets in the U.S. So we always want our foreign clients to own their assets in the United States through a foreign corporation or through a foreign trust. Because now the assets in the United States are owned by not an individual, owned by a foreign corporation, owned by a foreign trust. So when the individual dies, that individual does not directly own any assets in the United States. The estate tax does not apply. I'm Jacob Stein, and I hope you've enjoyed this brief overview of U.S. gift and estate taxation of foreign investors. Thank you.